Today I'm going to cover what is an ETF. An ETF is an exchange traded fund which has a bunch of underlying securities kind of in a basket. So those securities could be bonds, treasury notes, they could be mostly stocks, commodities, things like that. So for example, I'm just going to look at the Charles Schwab Dividend Equity ETF. It's something I bought back earlier this year and it's done pretty well. And what they do is they give you an indication of when you get your dividends. Some are monthly, some are quarterly, some ETFs don't have any dividends, but I chose this one which does have a good dividend. So it pays about around 3% for the dividend, and that goes up and down depending on the stock price. So you'll see today's opening was $52.74. The close, the range for the last year, and basically last month's average. And then the premium to discount gives you an idea of whether it went up or down since the previous month. It's gone down by a very small amount. So the average volume gives you, this says per 10-day period, so it was close to 1 million shares changed hands between people over the last 2-week period. And then you have the put to call ratio. This gets a bit more complicated, so I'm not going to go over that. And then it gives you your dividend payment, the pay date when you would have this go to your account, and the ex-dividend date. So if you hold the ETF or if you hold stocks on the ex-dividend date, which would have been June 26th, and even if you sold that stock or ETF or whatever it was after that ex-dividend date, you would still be paid on the pay date what that dividend was. The Morningstar investment style, large means it's a very large company, mid-sized company, or small company. It basically goes on market cap, or how much the share goes for multiplied by the number of shares. The value blend and growth, value basically means the stock pays dividends. Growth means that it basically doesn't pay much in terms of dividends. It's more of just appreciation or capital gains. And blend is a mix of some of the stocks will pay dividends and some won't. You see that it's an exchange traded fund, when it was founded, the number of holdings, so the number of stocks or whatever the underlying securities are. If it's leveraged, the fund company, so this is from Charles Schwab, and it gives you an indication of the total assets, so it has close to 10 billion. The expense and gross and net expense ratios are the same, 0.06%. You want to try to keep your expense ratios as low as humanly possible. I've seen some of these as high as 2.13%, and basically that just eats away at your savings over time. The gross and net expense ratios are important to keep as low as possible, and I'll show you that in a second. So this one is 0.06%. So let's just say, for instance, that our gains, our dividends and capital appreciation are only 7% per year, and we're investing about $6,000 a year. Say it's into an IRA, because that's about the limit, and that would equate to $115 a week, or less than $17 a day. If your gains are overall 7% per year and you have an expense ratio of 0.06%, this is your rate of return, just under 7%. Now let's say you invest this for 20 years. You would end up with about $244,000 of cash at year 20. Just to remember this. And we're just going to change one thing. So the stock market performs exactly the same, you get the exact same gains, and all we're going to do is pick a different expense ratio. Let's say that this expense ratio is 2.13. Your rate of return has now dropped to less than 5%. You put in the exact same amount of money over that 20-year period of time, but now you only have $195 and 592.19. Now, basically, because you chose something with a very high expense ratio, you basically lost $44,000 of your money. This is why expense ratio is very important. When you do invest in an ETF, or any stock for that matter, you also want to just kind of look through and see what other people think. Make sure, like a sanity check. So they also have these Morningstar Ratings where they'll tell you, hey, it's a 5-star out of 5, or 4, or 3, and they might give you the return has been very high, or the risk is average or low or high. You want to try to keep the risk as low as you possibly can and have your return as high as you can. But prior performance doesn't have an indication of future performance. And also, when looking at ETFs, you want to know what sectors and what types of things they're actually invested in. So coming down, they have consumer staples, IT, industrials, consumer discretionary, financial, healthcare, energy, communication service, materials, futures, etc. It's also good to look at the top 10 holdings to see what they're invested in. So Procter & Gamble, Home Depot, Coca-Cola, Intel, IBM, ExxonMobil, Verizon, Pepsi, Texas Instrument, Pfizer. So you see some pharmaceuticals and some tech, and you see like drinks with Coca-Cola and Pepsi, Verizon for communication, gasoline and other chemicals from refining at ExxonMobil. You have Intel and IBM, which are computers, Home Depot for building supplies, Procter & Gamble, so they produce a lot of the stuff that you would find in a bathroom. So I have found expense ratios as high as a little over 2%, so I just took that in the calculation. Why I really do like ETFs is that you can, depending on where you go, TD Ameritrade, Charles Schwab, and many of the other brokerages do have hundreds of $0 commission ETFs. This is a good way if you want to get in and out and not have to pay a transaction fee every time you buy and sell something. It's good if you can reduce your cost by removing any commissions when buying and selling stocks or ETFs or things like that. What if you were to buy $100 worth of stock every week? If you pay a $5 to $10 commission for each trade when you buy or when you sell, that $100 now just became somewhere around $95 to $90. That means you lost 5 to 10% right off the bat, which means you have to make more than 5 or 10% before you actually break even. And then when you go to sell it, you have to pay another $5 or $10 when you sell the asset. With a $0 commission ETF, it enables you to buy and sell, and you don't have to worry about losing that 5 or 10% each time you do that. Or actually, it could be much higher if you only have $50 or $20. Now, if you do have a much larger account where you do want to invest in more individual companies, and I wouldn't do this unless I had, say, over $10,000 in the account, and I'm going to be moving, say, $1,000 per transaction, then it makes sense to just pay the $5 because it's a very small percentage. Anytime you invest in anything, there is always some amount of risk associated with it. Generally, the higher the risk, the higher the potential reward. Note that I say potential because you also have the potential loss of losing everything you put into it. Nothing is guaranteed. Some things are safer, but not safe. There's always risk when investing. If you need money within the next, say, 10 years, your money doesn't really belong in the stock market. It belongs in something like a CD or a savings account or money market or something like that, something that's federally insured. But if you can let money sit, say, for over 10 years, then yes, I would invest in the stock market or in other investments. Hopefully you learned something new, and if you have any questions or comments, please leave them in the comments section and I'll get back to you as soon as I can. All right. Well, thank you. Have a great day.